Good morning, guys. Hello, Todd Grossman. I'm here with Brandon Sparks, one of our lending partners with Barton Creek Lending Group. So let's just jump right into this. We're going to try to make it quick, dirty, and easy for everyone to understand. So, I asked Brandon to try to help us out and understand really what the Fed cut means, what everything we're hearing. To me, I've been in this industry now 22 years, been recognized as one of the top brokers in a couple different markets. That, Brandon, what this Fed cut, what does this mean to interest rates? What does this mean to the markets? What do consumers really need to know, and what do they need to understand?
Yeah, absolutely. So just a little background. I've been in the lending arena for 16 years on the back of an econ degree, a business degree in economics. And so this is right up my alley in terms of monetary policy. And the Federal Reserve, their key role is to protect us against inflation, to preserve the value of the dollar. And they do so with certain operations such as interest rate cuts and other things that we call quantitative easing. You've heard the term QE, and I'll talk a little bit about that. But interest rate cuts are primarily designed as aid to the banking sector, down to the 0 to 0.25, relate to what's called the discount window. It relates to the space that banks go to borrow money. It relates to the amount of time that these banks have to borrow in terms of like a 90-day window, for example, to borrow at these low to no cost basis points. It also relates to the overnight exchange rates that banks borrow from each other. And a lot of people don't know that based on depository activity, that banks are borrowing from each other overnight. And so the Fed cut rates to 0 to provide ample liquidity, to provide a flow of money to banks so that there wasn't a run on cash. If you look in your economic history books, a lot of the runs we saw in the past, for example, the Great Depression, were sort of a double whammy. It was the stock market failing and then a run on cash at the banks, which collapsed the system. So the Fed did a great job of getting in front of this. Cutting these rates, and these rates, as far as consumers are concerned, will feel it with their credit cards. Those particular rates fall. Auto loans, if you go online and you look right now, interest rates for autos are in the 2s. So these have a direct impact. Now, mortgage rates are different. The 30-year, 20-year, 15-year fixed, all of the markets that we all know so well are not affected directly by the Federal Reserve. They don't control our rates. Mortgage-backed security, supply and demand, drives interest rates. And when you get a loan, when you refinance your loan, you become part of an overall mortgage-backed security package. And on the secondary mortgage markets where these things are traded, the supply and demand of those particular aspects, that's what drives pricing. So where they have helped us in this recent monetary policy move was back to that quantitative easing that you and I talked about here briefly. And that is a move where they purchase the bonds from the secondary market in order to create a demand and help control this massive volume that we have kicking up as a result of the refinance activity that's going on today. So that's kind of an overview of how the Fed works and how they're helping supply liquidity to our markets.
So for layman's, just and correct me if I'm wrong, so people truly understand, the Fed cut is helping bank to bank.
Yep.
The only reason, and that actually raised interest rates because the sell-off, and there was just too much out there, and people didn't want to take banks didn't want to take the risk. And the only reason why interest rates now have dropped after that has happened is because of the bailout, and the bailout is putting a Band-Aid over things to bring the interest rates down a little bit, so we just don't have a market that completely crashes, correct?
Yeah, there's I'm going to expand on that just a tiny bit and keep it succinct for timing. So a lot of times in the markets, the equities markets where people trade, they buy stocks, the Dow, the S&P, NASDAQ, those have higher levels of volatility. And sort of the opposite side of the coin is the bond markets, or are the bond markets, where you have the treasuries, the 2-year, the 10-year, the 30-year treasuries, mortgage-backed securities, bonds. When there's trouble or uncertainty in the equities, like the Dow, often institutional investors and investors alike will move from that marketplace over to a safer perceived market, which is the bond market, which is where we live as mortgages. So what actually drove the rates to fall was this increased demand for safer investments, this move to the bond markets. And if you go back to your old econ books, you'll know that supply and demand affect interest rates inversely. So the higher the demand, pushing the price up of the mortgage bond, the interest rates fall. That initially created the huge drop in interest rates, and that created the tidal wave of refinance activity. Capacity levels were tripped in the mortgage industry, and so artificially in our world, lenders were kicking up interest rates because they didn't have the capacity to meet all this demand, so they artificially raised rates, and that has stabilized in some capacity. But we saw probably 5 years worth of volatility in a matter of 2 or 3 days in terms of interest rates falling to the 2.9% range, and then all the way up to 4.75 in 5 days. It was incredible.